together. You've been growing. You've been creating initiatives with Stanford and the University of Chicago. You're going to talk about some of that. You were just with us at our Chicago conference, and I think you got your fingers on the pulse of our landscape. So look forward to how do you see the world today for family offices? Over to you.
Well, first, it's great to be here. I'm sorry I couldn't be there in person. And I'm always amazed. You've really done a remarkable job on building this. I've followed you for 5 years, and you've done a terrific job growing your organization. So, just as a quick background, my Black Swan event was my first job as Drexel Burnham, and I didn't foresee that coming. Graduated from Northwestern, worked at Drexel. Drexel imploded it, and I started a hedge fund, ran it for 10 years, and then I started investing. And basically what I do right now is I syndicate. I basically have, and I invest alongside about 100 family offices. These are families between 250 million to 30 billion, and we invest in the private market. So that's private equity, venture capital, real estate, and credit. I think that it's very difficult, even though I make money in the public markets, I think it's very difficult to make money today in the public markets. So we're going to talk today about where our family office is investing. What's interesting is I put together the family office initiative at Tiger 21, which is a wonderful peer-to-peer organization. And we were just purchased by a private equity firm, and a great private equity firm. And we had the first meeting with the private equity firm last night. And the very first part of the very first meeting was the 5-year plan. And if you think about that, does that make sense? Because it's a 5-year plan because we already know when they're going to sell to the next firm, because that's how they're compensated. So I think what's going to happen is you see companies that are bought, they're going to be held for 5 years, and then they're going to be sold. And then they're going to typically be bought by another private equity firm, and they're going to hold it for 5 years and perhaps sell it. And if you look over the course of 20 years, one company could trade hands 4 to 5 times. And if you look at the taxes, if you look at the friction, and if you look at the inefficiencies, versus a family office who can simply buy it, hold it for 20 years and let it compound, the results aren't even close. The problem is that very few family offices can execute. So I think that as private equity and venture capital disrupted the public markets in the late 80s, and it became a multi-trillion-dollar industry and extremely lucrative, I believe that family offices are now going to start to not replace but disrupt private equity and venture capital because it has become an AUM game. These funds they're getting too big, and there's an inherent conflict of interest with it. I think family offices right now, if we're investing the way that I'm looking at it, in the private markets, real estate obviously is 23% of the asset allocation for family offices. It's going to always be popular, and private equity is probably about 15%. That will always be there. I think what's going to happen is you're going to start to see more and more families work together. So right now, the whole model, it's very opaque. The family office, it's very inefficient. It's very fragmented. It's very siloed. The model doesn't work. 25% make it to the second gen, 10 make it to the third, 5 make it to the fourth. But you've got $105 trillion coming downstream. And you've got $10 trillion in equity, in capital. So this market today is larger than the entire hedge fund market globally, but it's going to be larger in the next 20 years than the private equity market and venture capital market combined, with $105 trillion coming downstream. So I think what's happening is a lot of these family offices are now starting to professionalize. And I think that's going to be a fundamental change in how companies are financed going forward and how these family offices invest. And I think family offices look at through the lens of, IRR is not really relevant for them, right? Because they don't have to report to investors and flip a company every 5 years. So they look at more things from the macro standpoint, and they would love to hold a company forever. We just put together the initiative at University of Chicago booth, and what was amazing is, these kids, everybody at booth, they understand what private equity is and venture capital and real estate. We put together a class on family offices, and it sold out immediately. There were 65 kids in the class, and there's a wait list for it. And the amount of demand for it is over the top. Once I announced this, I was called by MIT, by Harvard, by Vanderbilt, by Northwestern, by a bunch of other schools who will ultimately will start this because I think that ultimately this has to happen at a university level. I think that right now we're at an inflection point with family offices. Again, what we're trying to do at Booth is basically professionalize what family offices can do. Right now, you know, we work closely with Paul Carbone, who runs a family for Tony and JB Pritzker. They can buy a company, they can compete directly with Carlyle, Blackstone, KKR, and they've actually got objectively a superior model because they don't have a shot clock. They don't have to hold it for 5 years and then sell it. But the problem is that very few family offices can execute right now. I think that's going to change, and it's starting to change. So what I see happening is what we're building at Booth, and I think what's inevitable is going to happen. I could be wrong timing-wise, but I'm right directionally. The first choice of kids out of these top business schools going forward is going to be working for family offices. Now, it's not going to happen next year, through 2 years, but over the next 5, maybe 10 years, it will be the first choice. And what family offices are starting to do, they're starting to professionalize more. They're starting to get their compensation model right. So right now, a family office, you know, if they pay a kid $250,000 out of Booth, they look at that as a cost. If Carlyle or Blackstone pays a kid $250,000, they look at that kid as a potential $20 million profit center, not a cost. So there's a long way that we have to go. I think we're only in the second inning in the evolution of family offices, but I think it's a fascinating dynamic because it will be disruptive, and with the amount of capital coming downstream, and with the younger generation who looks at the things through a different lens than my generation. I would buy a pair of jeans if it fit. I've got beautiful 21 and 24-year-old daughters. If it fits, that's the first criteria. They want to know who makes these jeans, how do they treat their employees, and they've got access to the internet, so they can get that information. I think they're changed. People are investing differently, and again, the amount of money and the capital in family offices is just $105 trillion. It's the largest transfer of wealth in history. So what I want to do is really do more Q&A than talk, because there's a lot of questions about this, and I'm happy to answer any questions that you guys have. But just from a macro standpoint, I think that in the family offices in general are going to be investing much more in the private markets than the public markets. I think in the public markets, there's something called structural alpha. PPLI, which is private placement life insurance, is an example of that. It's basically a tax wrapper. I was at a presentation a couple weeks ago. There's a for AQR. It's a $150 billion quant hedge fund. They, you know, a lot of the families are doing this. They basically created an index, and you invest in the index. And while you're investing in the index, maybe they say they can maybe outperform, but maybe they can't. But it can kick off a huge amount of tax losses at the same time. So structural alpha is something I think we're going to be hearing a lot more about, how family offices invest. Patient capital is a term that you've heard, and you're going to hear more and more again, because we, family offices, have the ability to be flexible. The firm that just bought Tiger, they're already on the shot clock. They're going to sell the firm in 5 years, and it doesn't make them bad people. They're actually a great firm. But they've got to report to their shareholders, and then they're going to sell it again. So I think you're going to see a fundamental shift, and it's going to be fascinating to see. So I want to keep this more at a macro level, but I'm happy to answer any questions, because what I see happening right now is that everybody wants to get into the family office world. Like every bank, every law firm, every accounting firm, it's where the money is. But it's very hard, and they can't crack it. And what family offices look for is the first, second, third thing the family offices are looking for is, can they trust you? And the fourth thing is, what's your track record? And I think institutionally that's flipped. So the reason I think there's so much growth in family offices, it's not that everybody all of a sudden wants to manage money and is good at it and enjoys it. It's just that they stop trusting Wall Street. Many cases justifiably, so they want to do it themselves. So you've got a situation right now where this can't not happen. Now, directionally it's going to happen. The question is it going to take 2 years, 5 years, or 7 years? But I see a tremendous opportunity for family offices to invest with other family offices directly, bypass the private equity firms, And that's what we see happening. So with that, I'm happy to answer any questions, but I think from a macro standpoint, you're going to see a fundamental shift in the way family offices invest, and because they've got flexible capital, they could do it on a much longer duration than most people.
So thank you, Ron, for kicking off this discussion. As you say, the challenge is that the execution, either abilities or let's just say the DNA, they're very siloed, they're very private. I work for one that we had to create an army if you're going to compete with private equity. I think they have to also be more open. So not everybody's going to join that journey, but can you show some examples other than the Pritzkers that you see moving
Sure.
that direction?
Yeah, and no, you raised a great point, and it's incumbent upon us, it's incumbent upon the family offices to become more open. Because if you're a family office, if you want to be private, fine, it's your prerogative, but you're not going to be able to compete with the other firms, because if you invest in real estate and people don't know that you invest in real estate because you want to remain secretive, you're not going to see the deals. So it's incumbent, what the Pritzkers did as an example, is yes, they opened it up. I think more and more families, when Michael Dell's family at MSD merged with Byron Trott, I think you're going to start seeing more and more of these large family offices actually raising capital, more capital. I mean, the Pritzkers are an extraordinarily wealthy family, but at the end of the day, capital is still finite, right? And if you're going to, Paul Carbone, who's a good friend, has a team of 65 people. Well, at some point, the billions of dollars end, right? And you have to raise more money. That's what they've chosen to do. I think you're going to see more and more family offices do that. We're seeing more and more family offices starting to think about, should we raise money and invest with other family offices? Sort of like bypassing the what they consider conflicts on Wall Street. And I think more and more family offices are starting to show what they're looking for. We're still in the second inning, and we do a very poor job at it. I think in 5 years, I did a podcast with David Rubenstein, and he felt that in 5 years, maybe 10 years, that his family office is called Declaration Partners, which probably very few people have heard of. His business is Carlisle, which almost everybody's heard of. He believes, and I think this is true, in 5 years, the Declaration Partners is going to be a brand name. And Pritzker Private Capital will become a brand name. And that's what's going to happen. So I think you're seeing more and more, it's a great point you raised, Mark. I think you're seeing more and more families open up, start to share what they're looking for. Because if they don't, they cannot compete with the firms. And if they do, they've objectively got a better model. They just have to figure out how to execute.
So I think Rubenstein is a brand name. I'm not sure Declaration is yet, but he was referred to.
It's not, but he's saying it's going to be.
I don't hear you. He was referred to it yesterday, but not as Declaration, but as Jeffrey Rubenstein. But you're right. Questions, other questions? And if you could just introduce yourself.
Sure. Hi, Rod. So my name is Tom Brakovich. I'm with DCA Family Office out in California. I have seen this trend where some of the larger family offices are trying to basically build direct private equity shops in-house. So Pritzkers, I was helping Josh Harris do this. You mentioned some of the others. Is that necessarily the right way to go? I mean, are there alternatives? So the way I think about it is there's a huge amount of latent expertise, talent, deal sourcing, ability to round trip, manage deals already out there in the private equity space or private real estate space, whatever you want to call it. Is there a way to partner with those firms instead of actually trying to compete with them? And have you thought through that? It's very expensive to build a direct private equity shop, as you said, hiring the people, keeping them incentivized, motivated. It's very hard to do that from scratch, but it already exists out there, right? So have you seen other models where partnership is the way to go as opposed to trying to directly compete?
That's an excellent point and a great question. Look, the way I look at it is that it comes back to alignment of interest, and I think that family offices, we've got to get the compensation model right, which we don't have. Right now, they look at it as a cost, not a profit center. change. Once we get the compensation model right and what we're doing at Booth and the top kids understand it, and it'll be hopefully a feeder system for some of these family offices. And then not just Booth, and Kellogg's going to do something, and Harvard's going to do something, and Wharton and Stanford, and I think a whole bunch of universities will do it. So they'll have the bench, and the money, the transfer of wealth is happening as we speak. It's just starting, the wealth transfer. So I think that the model of competing with the private equity firms, the reason is that in many instances, not all, but in many instances, they kind of bastardize the business. It's become an AUM game. And what should be a $300 million fund is a $3 billion fund, if they can do it. And if you do the math, it makes sense for the GPs, but not necessarily the LPs, right? So if you're getting an annuity of 2% and $3 billion every single year, irrespective of what you do, it's not good for the LP. So I think that the family offices are looking at this and they say, I had a friend, I think I mentioned to Mark before, he did a roll-up of logistics companies. He needed 150. It's a niche strategy, and the placement agent got him $500 million. He just said he needed 150, and the placement agent's like, why would you only want 150 when I can get you 5? And he said, well, because if I do that, what you want me to do, I won't have a fund too, because I can't execute on 500. I can execute on 150. And I know I'm smart enough to know that 2% of 500 is more than 2% of 150, but there won't be a fund too. So it'll be better for me short term, but not for my investors, and long term it's going to impact me. That's a microcosm of what's wrong. So I think these family offices are frustrated with the private equity firms. I mean, just because, if you could raise $10 billion, you raise $10 billion. The true alpha is created really in the funds that are between $250 million and $1 billion, not in the $25 billion funds. And I think that's the reason the family offices are going to continue to look at ways to disrupt and invest together. Now, what I do see happening is what happened post-crash, pre-COVID, no matter what you invested in as a family office, you made money, or as an investor, you made money. Stock market went up, private equity went up, venture capital went up, interest rates were zero, not hard to make money in real estate, Bitcoin went up. Well, when they started jacking up interest rates, now a lot of these family offices are not only not making money, but they're losing money. So I think how this is going to play out is the family offices are not necessarily going to invest direct themselves. If you made money, if Neil Bloom made money in real estate, I would invest with Neil Bloom in real estate and then outsource other stuff. I wouldn't listen to Neil on a deal on venture capital because that's not what he did. And I think what's going to happen is Greg Watson, for instance, is a founder, former CEO of Walgreens. If it's a healthcare deal, I would like to invest with him, and so would a lot of family offices, let him kind of lead the deal and find people who are best in class at what they do. That's what I think is going to happen, but it's not happening. It's just starting to happen. We're feeding the university system, and again, it's a 5 to 10 year process for this to truly become more professionalized. But I see the writing on the, I see these kids at Booth, I see the class, just all the family office sell out instantly, most popular class at Booth, and I see all these other universities want to, mimic what we're doing, and that's fine, because they ultimately will, but I see that, and the reason is that they just want to invest where there's an alignment of interest, and there's an element of trust. And right now, family offices are very skeptical about Wall Street and about the alignment of interest of a lot of the private equity firms.
So just two things there. I guess one idea, Tom, is what we advise is you can partner as an LP. You have to find the right private equity funds that you can put a ticket into them and get, like you're doing. You're getting a co-invest access. You can use your domain expertise. You don't, because you may not have some of those people made a lot of money in real estate, but they never made money for others, maybe. That's a different DNA. I think that's another challenge, to really care, to steward other people's capital. When, I'm just putting that out, Ron, but I don't know if it's a full circle to part of what you're saying.
I mean, we basically built a co-investment model, so we're using the expertise of all the GPs that we've known and developed relationships with for the last, 20 years of our career. And we're accessing their deals basically, but we're not. Yeah, sorry, I don't know if you can hear me. I mean, we basically built a co-investment model, working with all the GPs that we've known for 20 years. We're not pretending that we know how to actually do what they do because, frankly, we don't, right? So a little bit it's like knowing what you are good at and what you aren't good at. But also, too, there's this theory of diversification, right? Like, there's a ton of great lower mid-market healthcare private equity firms, but that's not going to be everything I want to put in the portfolio for the families that I work with, right? I need to find those guys, I need to find the guys that know industrials, I need to find the guys that know tech, I need to find the guys that know materials, whatever. It's very hard for me to build a direct model, if you will, that's generalist, that can actually, be expert and best in class in all those things. So, in our opinion, choosing to partner with them in a sense, but, find a way to access their deals and do that in a, helpful way. Can be a better model than trying to go out there and build direct shop. So anyways, just a thought for the crowd.
Yeah, no, I agree with you. I'm not saying that, look, most family offices don't have well, certainly today they don't have the infrastructure or the bench strength to do it, right? I mean, yeah, Pritzker can do it, there's a handful of companies that can do it, and I think more and more will be able to. But ultimately, yeah, there will be partnerships. But I think that these family offices, I think what's going to happen is, the Greg Watson, who is the former CEO of Walgreens, he's going to invest in a healthcare deal. The alignment of interest will be different because he's not going to be creating this fund where he has to flip it every 5 years in order to satisfy the investors. And you're going to see groups of families club these deals together, and we're starting to see that happen. But what's not happening is, because like I said, Neil Bloom has a great idea. Said this is a great venture deal. He's not a venture guy, he's a real estate guy. So I think what's going to happen is you're starting to see this. More and more families are realizing, and it only really happened a couple of years ago, because before they started jacking up interest rates, and you're making money on everything, it's like, why pay 2 and 20 if I could pay 0 and make money? And they were right until they were wrong. But it's hard. There's a skill set to investing in real estate. There's a skill set to investing in private equity. There's a skill set to investing in credit or venture capital. And not everybody has it. So I think how it's going to play out is the family offices are going to find those people who made their money in that specific vertical, who are best in class, and they're going to club these deals together. And they don't have the shot clock like the firm that just purchased Tiger 21, who in 5 years, again, they're probably going to sell, which is the typical private equity model. But again, I don't think for the investors, long term, I think that it's just a superior model if you don't have an artificial shot clock, and if you basically have the ability to hold it as long as you like. You could sell it in 3 years, but you don't have to. You could hold it for 20 years, and a private equity firm can't.
We got a few more questions. Bill?
Right. Ron, good to see you. Bill Eichler here. To your point, and also to Tom's point, my neighbor at home actually is a CIO for a newly formed $1 billion family office. The wealth creator was in consumer products, and that's exactly what they're doing now. Is they're completely focused on building out single deal opportunities in consumer products. They're completely staying in their lane. They're not really clubbing with any other family offices. But between the wealth creator and the staff that they have assembled so far, they feel as though they have enough expertise to be able to build out essentially a multi-product type of firm that's there. So where they're being very specialized and not having this grand idea of, well, we're going to be the next BlackRock or Blackstone, things like that. So as an interim step, do you see that that's happening? And also, looking generationally, what kind of metrics do you think, of a family like that should be looking for?
Well, I think not only is it happening today, I think it's going to continue. I think the trend's going to continue. And I think what you're going to see is more and more of these family offices that, they made money in consumer products. Stay in that lane, okay? I'm not a consumer products guy. I try to delegate to people who are smarter than me in different areas. So I think what's going to happen is you're going to find these family offices focusing, most people don't have as much money as the Pritzkers. So you're right, they're not gonna necessarily compete on everything with the KKR, but what they're gonna do is they're gonna say, I made my money in real estate, and that's where they're an expert. Tim Callahan was Sam Zell's partner. So if Tim Callahan is a real estate deal, I'd like to invest with that, because I know he knows real estate inside out, and I know that they don't have the shot clock, and it's a better model, there's not a conflict of interest. That, I think, is what I see is going to happen. So I think what you're going to see happening is these family offices are going to start staying in their lane, investing in what they know best, where their domain expertise in private equity or venture or real estate or consumer products, whatever it is. And then the other family offices are going to say, well, I'm great in real estate, but I'm not great in this. I'll invest in your deal, you invest in my deal. That's what's going to happen, but it's going to take time to do it, and we had to do it at a university level because at the end of the day, I speak at a lot of these conferences, and a lot of the conferences, Mark's created an extraordinary conference with complete alignment of interest with everybody. But a lot of these conferences are, if you're speaking, you spent $25,000 to speak. That's not the reason you should go to a you should listen. And we're putting together a family office initiative at Booth, where basically it's going to be 250 families and 0 service providers, and most of these conferences, that's flipped. So I think you're starting to see that, but I think you make a great point, and I do think that's what's going to happen. You're going to find the people who are experts in whatever domain they made their money, stay in that lane, build out a team specifically in that lane. Other families are going to club deals with them, and if it's a healthcare deal, they're going to go to Greg Weston. If it's a real estate deal, they're going to go to Tim Callahan. If it's a venture deal, they're going to go to a top venture guy.
Ron,
that is what's going to happen.
can I've lived this. So I was the family office that stayed in this lane. We knew commodities, we knew logistics. The other thing you can do is leverage the private equity. We bring the deals. We put in 20 million. You put in 180. We're not 10-20. We're more like 20-80 because we're doing all the work for you. You're going to net more. So that's what we did from 2004 to 2013. And I think that's also, because if you know something, you're the smartest one in the room, but you can't buy that company without some capital partners. And the families, I'm sorry, you're flaky. You're not set up. You don't have committees. You're not ready to do the deals.
Well, Mark, what's interesting is when I talk to Tony Pritzker, he won't let the people at Pritzker Private Capital refer to themselves as family office, because he thinks right now family offices, which he's correct, are inefficient. He doesn't want to be lumped with the family offices because most of them are inefficient, fragmented, and siloed. So he wants to call it private capital, right? He refuses to call it family offices. So right now, a lot of people look at a family office and they look at it, it's whimsical. They're not there yet. I think in 5 years, maybe 7, he'd be happy to call himself a family office, but today he's not. But you could just see that everything's starting to change. And the biggest obstacle, and I see it, the biggest obstacle to these families, the family offices, and it's a huge obstacle, is the ego of the founder. Because, Ty Warner sold Beanie Babies doesn't mean he could buy the Four Seasons Hotel. And that was a disaster. And you see example and example of that. And as family offices are starting to lose money in these deals, they're starting to get smarter. And if we educate the next generation, right, with not just Booth, but at other schools, in 5 to 10 years, this is going to become an industry. Right now, it's not. Right now, it's just a lot of money and very few.
I just realized that we could definitely, particularly you and I, and any third, let alone 100 people, we could talk for a day on this subject. I think we should. We keep on doing these half-hour, 45-minute segments. So I appreciate your time, Ron, and we'll get together in person soon, I hope, and carry on this conversation. Thank you.
And then we should also continue. I mentioned at the very end, Michigan obviously didn't have a great football team this year. They were actually pretty poor.
What, Northwestern? Which bowl game did you go to?
They cheat, and
but they cheated well enough apparently for your daughter to go there.
I did not want my daughter to go there.
Oh.
We don't cheat.
Okay, we're losing the connection with you.
I think
Something just happened.
Bye.
Fine. Thank you.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.